Why investing matters. Cash sitting in a savings account earns very little, often less than the rate at which prices rise over time. So money left there quietly loses purchasing power even as the number on the statement stays the same. Investing means putting money to work in assets likely to grow faster than the cost of living, giving you a real shot at building wealth rather than just preserving it. Much of the mystery around investing comes from an industry that benefits when things seem complicated. But the core ideas are simple. Spend less than you earn, put the difference into assets that tend to grow over time, give them time to compound, and avoid the behavioral mistakes that cause people to buy high and sell low. This book won't turn you into a stock picker, but it will help you open an account, understand what you're buying and why, build a simple plan and stick with it, which is the single most important skill in investing. Chapter 1. Money Basics, Saving, Spending, and the Power of Compounding. A dollar today is worth more than a dollar next year because of inflation. Prices generally rise over time, so your money needs to grow at least as fast just to maintain its value. Compounding is the flip side, and it's where investing becomes powerful. When returns themselves start earning returns, growth accelerates. $1,000 growing at 7% becomes about $8,000 over 30 years, not through cleverness, just through time. This is why starting early matters more than starting big. Someone who invests modestly in their 20s often ends up ahead of someone investing much larger sums starting in their 40s, purely because their money had more time to compound. None of this works without money to invest, which comes down to consistently spending less than you earn and directing the difference toward your future. This doesn't require extreme frugality, just intentionality, ideally treating saving as one of the first bills. You pay each month rather than whatever's left over. Even small, consistent, regularly invested amounts can grow into something substantial given enough time, a far more realistic path to security than waiting for a windfall. Chapter 2. Know Thyself, Goals, Time Horizons, and Risk Tolerance. Before asking, what should I invest in, ask, what am I investing for and when will I need it? Money needed soon, like a house down payment in 2 years, should stay safe and accessible since there's no time to recover from a downturn. Money you won't touch for decades can take on more volatility because there's time to ride out the ups and downs. This is your time horizon. The longer it is, the more you can lean toward growth-oriented assets like stocks. The shorter it is, the more you should favor stability, even at the cost of lower returns. Risk tolerance is related but distinct. It's both how much risk you can afford and how much you can emotionally handle, and these aren't always the same. Someone who could theoretically ride out a 30% drop on paper but would panic sell in reality is better served by a more conservative portfolio, because their behavior, not their theoretical capacity, determines the outcome. A useful exercise: write down your major goals, rough timelines, and how you'd honestly feel if your investment dropped 10%, 20%, or 30% shortly after investing. The right strategy isn't the one with the highest possible return. It's the one that lets you sleep at night while still making steady progress. Chapter 3. The Building Blocks: Stocks, Bonds, and Cash. Nearly every investment is built from 3 basic ingredients. A stock represents partial ownership in a company. If the company grows and becomes more profitable, your share tends to rise in value, and you may receive dividends. If it struggles or fails, shareholders are last in line and can lose everything. Stocks have historically returned around 7–10% annually over long periods, but can drop 30–50% during downturns before recovering. A bond is a loan. You lend money to a government or company in exchange for a promise of repayment plus interest by a set date. Bonds are generally less risky than stocks, since repayment is a legal obligation rather than a bet on business performance, but they typically return less, often 2–5%, with much smaller price swings, useful for balancing out a stock-heavy portfolio. Cash and cash equivalents, savings accounts, money market funds are the safest and lowest returning category. Their job isn't growth, it's stability and accessibility, acting as a buffer so you're never forced to sell stocks or bonds at a bad time because of an unexpected expense. Most portfolios blend all three, with proportions shaped by your goals and risk tolerance. Chapter 4. Funds, mutual funds, index funds, and ETFs. Most beginners shouldn't buy individual stocks one at a time. Instead, funds pool money from many investors into a basket holding dozens, hundreds, or thousands of investments at once, giving instant diversification with a single purchase. A mutual fund may be actively managed, with a professional picking investments in an attempt to beat the market, charging higher fees for that effort. Decades of research show most active funds fail to beat simple market benchmarks after fees, though a few succeed. An index fund instead simply tracks a market index, like the S&P 500, with no active picking required, which means dramatically lower fees. Over long periods, this combination of broad diversification and low cost has let index funds outperform most active funds, not through cleverness, but by avoiding fee drag and manager error. An ETF is similar to an index fund, but trades on an exchange throughout the day like a stock, rather than being priced once daily like a mutual fund. For a beginner, the practical difference between a low-cost index mutual fund and a similar ETF is usually small, and either can serve as the core of a portfolio. Chapter 5. How markets actually work. A stock's price is simply the point where a buyer and seller agree to trade. More buyers than sellers pushes prices up. The reverse pushes them down. Short-term moves are often driven by headlines, earnings reports, and shifting investor mood, essentially noise with little long-term meaning. Over the long term, though, prices tend to track the actual performance of underlying companies and economies, which is the basis for buy-and-hold investing. Rather than predicting noise, you own a broad slice of the economy and let long-term growth work for you. A correction usually means a decline of about 10% from a recent high, while a bear market means a decline of 20% or more. These happen regularly, every few years on average, and markets have historically always recovered, though the timing varies. The investors hurt most aren't the ones who hold through downturns, but those who panic sell near the bottom and then miss the recovery. Since some of the best market days often come right after the worst ones. Chapter 6. Building your portfolio, asset allocation and diversification. Asset allocation, your mix of stocks, bonds, and cash, is arguably the single most important decision you'll make, more impactful than which specific funds you choose within each category. A stock-heavy portfolio, 80–90%, offers higher long-term growth potential but bigger swings. A more balanced mix, 60–40 or 50–50 stocks to bonds, grows more slowly on average but with a gentler ride, since bonds often hold up or even rise when stocks fall. There's no universal right answer, only what fits your time horizon and risk tolerance, often shifting toward more bonds as you near your goal. Diversification means not putting all your eggs in one basket, both across and within asset classes. Owning one company's stock means a single failure could wipe you out. Owning a small piece of 500 companies through an index fund means no single failure matters much. A simple, popular structure for beginners is a 3-fund portfolio: a broad domestic stock index fund, an international stock index fund, and a bond index fund, with percentages adjusted to fit your situation. Simplicity is an advantage here, easier to understand, easier to stick with, and less likely to tempt frequent trading. Chapter 7. Getting started, accounts, brokers, and your first investment. The first decision is account type. Many countries offer tax-advantaged retirement accounts that reduce or defer taxes on contributions or growth, and if your employer offers matching contributions, that's often the best deal available to a new investor, essentially free money. A standard brokerage account works for any goal, with fewer restrictions but typically no special tax treatment. To invest, open an account with a reputable, regulated brokerage. Many now have no minimum balances and no trading commissions. Link a bank account and you're set. Buying is simple. Search by ticker symbol, choose a dollar amount or share count, and place the order. A basic market order is fine for beginners. Setting up automatic recurring investments, dollar cost averaging, removes the temptation to time the market and turns investing into a habit. You don't need a lot of money to start. Many funds are affordable per share, and fractional shares let you invest any amount. The goal isn't a perfect first investment, it's to start and keep going. Chapter 8. Common mistakes beginners make. The most costly mistake is trying to time the market, jumping in and out based on predictions. This is extremely hard even for professionals, and missing just a few of the market's best days, which often cluster near its worst days, can significantly hurt long-term returns. Letting fear or excitement drive decisions, selling in a panic during downturns, or chasing whatever's currently hot, is buying high and selling low in disguise. Chasing recent top performers is another trap, since past performance, especially short-term, says little about the future, while fees are far more predictable. A 1% versus 0.1% fee difference can cost tens of thousands of dollars over decades. Other common errors include overconcentrating in a single stock, especially your employer's, checking your portfolio so often that normal fluctuations feel alarming, and investing before having an emergency fund. Finally, be wary of anything promising unusually high, guaranteed returns or pushed with urgency and pressure. If it sounds too good to be true, it almost always is. Chapter 9. Taxes, inflation, and other real-world wrinkles. Investment gains, dividends, interest, and profits from selling are usually taxable, though rules vary widely by country and account type. Tax-advantaged retirement accounts let more of your money stay invested and compounding rather than being chipped away each year. Many tax systems also tax short-term gains, often under a year, at higher rates than long-term gains, another reason the buy-and-hold approach tends to work well. Inflation deserves a second look. Even 3% annual inflation roughly doubles prices every 24 years, meaning cash that feels comfortable today may buy half as much by retirement. This is why even cautious investors usually hold some assets that have historically outpaced inflation, like stocks, rather than sitting entirely in cash. If you invest internationally, currency fluctuations can also nudge returns up or down independent of how the underlying investments perform. Worth knowing, but not something to obsess over. Chapter 10. Staying the course, strategy, patience, and mindset. The biggest factor in investing success for most people isn't intelligence or special information, it's behavior over time. The strategies in this book, diversification, low costs, regular contributions, a fitting asset allocation, are widely known. The hard part is sticking with them, especially when markets get volatile and every instinct says to do something different. Downturns test this most. Seeing your balance drop can feel alarming even when you know it's normal, and news coverage tends to amplify that feeling. Investors who do best are usually those who expected downturns in advance and had a plan for them, rather than improvising mid-crisis. Revisit your goals and allocation periodically, maybe once a year or after major life changes, and rebalance back to your targets as needed. That's healthy maintenance. Reacting to headlines is not. A portfolio that never makes you the slightest bit uneasy probably isn't growing much either. The goal isn't zero discomfort, just a tolerable level that doesn't provoke destructive decisions. Chapter 11. Putting it all together, a simple starting plan. First, build a small emergency fund covering a few months of expenses, kept safe and accessible, so you're never forced to sell investments at a bad time. Second, capture any employer retirement match available to you. Third, clarify your goals and time horizons, and use your risk tolerance reflection to settle on a rough stock-to-bond mix. Fourth, pick a small number of low-cost, diversified funds, a total stock index fund, perhaps an international fund and a bond fund, and open an account at a reputable brokerage. Fifth, automate regular contributions, even small ones. Consistency matters more than size. Sixth, and most importantly, largely leave it alone, checking in roughly annually to rebalance, while resisting the urge to react to headlines or short-term performance. This approach is deliberately boring and repeatable, and the same principles, diversification, low costs, consistency, patience, remain the foundation even as your knowledge deepens. Conclusion: investing seems intimidating from the outside, but the core ideas, compounding, matching investments to goals and time horizon, broad diversification, low costs, and consistency through ups and downs, are accessible to anyone, requiring no special talent or large sums to begin. What they do require is patience and tolerance for some discomfort, since markets rise and fall and staying the course will sometimes feel hard. That discomfort is the price of admission for long-term growth, and it gets easier once you understand it's normal rather than a sign something's wrong. If you take one thing from this book, the best time to start is now, with whatever amount you can comfortably set aside in a simple, diversified, low-cost portfolio matching your goals, contributed to regularly and left to grow. Everything else can be refined along the way. Getting started is, by far, the most important step. Quick glossary. Asset allocation asterisk, how a portfolio is split among stocks, bonds, and cash. Bear market asterisk, a fall of 20% plus from a recent high. Bond, a loan to a government or company that pays interest and returns principal. Compounding, returns generating their own returns over time. Diversification, spreading investments to reduce the impact of anyone failing. Dividend asterisk, a share of company profits paid to shareholders. Dollar cost averaging, investing a fixed amount on a regular schedule. ETF asterisk, a fund holding many investments that trades like a stock. Expense ratio asterisk, a fund's annual fee as a percentage of assets. Index fund asterisk, a fund that tracks a market index at low cost. Inflation asterisk, the rate prices rise, eroding money's purchasing power. Rebalancing asterisk, adjusting a portfolio back to its target mix. Risk tolerance, your ability and willingness to handle investment ups and downs. Stock asterisk, a unit of ownership in a company. Time horizon asterisk, how long until you'll need the invested money.